Welcome to Charged Alpha. I'm Hudson, joined by Lana. Today's chapter, Apollo Global Management, the alternative asset powerhouse that turned retirement insurance into a $650 billion investment engine.
Apollo was born in 1990, when Mark Rowan, Leon Black, and Josh Harris walked out of Drexel Burnham Lambert and set up shop in New York with a contrarian, credit-first philosophy.
They built a reputation on distressed debt, buying what others feared during the dot-com bust. When Apollo went public on the NYSE in 2011, that reputation was already worth billions.
The defining moment came in 2022 when Apollo completed its full merger with Athene Holding. The $11 billion deal gave the firm permanent insurance capital, something most asset managers can only dream about.
Mark Rowan stepped up as CEO in 2021, the co-founder who had championed the Athene thesis for years. His vision: pair Apollo's origination muscle with Athene's long-duration insurance liabilities.
Today, Apollo runs two business segments. Retirement services from Athene drives roughly 89% of total revenue, $27 billion in FY 2025 alone, powered by Athene's massive annuity and insurance float.
Asset management contributed another $5 billion in fees and carried interest, bringing total FY 2025 revenue to $30.3 billion, up 16% year over year.
Gross margins sit at 88%, reflecting the spread-based insurance model. Operating margin came in around 34%, and fee-related earnings grew 18% to approximately $2.1 billion, the metric institutional investors watch most closely.
Apollo's annualized dividend stands at $2.04 per share, a 10% increase from the prior year, representing about a 1.6% yield at current prices. 3 consecutive years of growth since the 2019 C Corp conversion.
The distribution was restructured when Apollo converted from a partnership to a C Corp in 2019. Since then, the payout has grown in 3 of the last 4 years.
Competitively, Apollo sits alongside Blackstone and KKR at the top of alternatives. Where Blackstone dominates real estate, Apollo owns credit, running the largest credit alternatives platform on the planet by deployed capital.
That credit edge is structural. Apollo originates loans directly for Athene rather than buying in secondary markets, capturing the origination premium and locking in returns that peers simply cannot replicate.
Apollo's global platform spans more than 25 offices in 45 countries, serving over 1,000 institutional clients, pensions, sovereign wealth funds, and endowments seeking reliable yield in a rate-sensitive world.
That global reach also feeds deal flow. International relationships surface private credit opportunities that U.S.-only competitors miss, adding another structural advantage to Apollo's origination engine.
Mark Rowan earned his economics degree and MBA from Wharton, then spent 4 years at Drexel before co-founding Apollo at age 27. He's been the architect of its credit and insurance strategy for 3 decades.
Rowan's edge is intellectual discipline. He built the Athene partnership years before the full merger, methodically proving the model before committing $11 billion to seal it permanently.
That patience is now paying dividends, literally. The combined Apollo-Athene platform generates spread-related earnings that are more durable and predictable than traditional PE performance fees alone.
Apollo's Q1 2026 results are in, and with $650 billion in AUM, and Athene's spread engine running at full capacity, the earnings story is about to get very interesting. Stay tuned for the full breakdown.
Apollo Global Management beat Q1 2026 earnings estimates by 2.6%. Apollo's private credit platform is growing at the center of the great capital markets disintermediation, replacing traditional bank lending with direct institutional-scale credit solutions. With over $1 trillion in assets under management and Athene providing permanent insurance capital, Apollo is compounding at scale. This is Charged Alpha. I'm Hudson.
And I'm Lana. Apollo Global Management is one of the world's largest alternative asset managers, with over $1 trillion in assets under management across private equity, private credit, and real estate. Founded in 1990, Apollo has evolved from a distressed debt specialist to the leading provider of investment-grade private credit globally. The Athene insurance acquisition in 2022 provides permanent capital that distinguishes Apollo from pure fee-based asset managers. Market cap is approximately $180 billion.
CEO Mark Rowan has led Apollo since 2021. Rowan's thesis is that insurance liabilities, predictable, long-duration obligations, are the ideal match for investment-grade private credit yields. Athene's balance sheet provides Apollo with a captive institutional investor that allows origination at scale without dependence on traditional capital raising cycles.
Starting with Apollo's financials, Q1 2026 adjusted EPS beat the consensus estimate by 2.6%, reflecting growth in both fee-related earnings and spread-related earnings. Apollo reports on two primary metrics: fee-related earnings, management and transaction fees from asset management, and spread-related earnings, net interest income from Athene's insurance platform. Both grew year over year.
Fee-related earnings are the stable, recurring core of Apollo's asset management business. As total AUM grows, through capital raising in private credit, real estate, and private equity, the management fee base expands. Apollo's fee rates are modest on a percentage basis, but the scale of the AUM base makes aggregate fee revenue substantial and highly predictable across market cycles.
Spread-related earnings from Athene represent the insurance overlay that distinguishes Apollo's financial profile. Athene collects annuity contributions, and Apollo invests those liabilities in investment-grade private credit assets, yielding a spread above the cost of insurance obligations. The spread, typically 200 to 300 basis points, multiplied by Athene's asset base, creates a second compounding earnings engine.
Private credit origination is Apollo's primary growth driver. Apollo originates direct loans to corporations and infrastructure projects that historically accessed bank lending or public bond markets. Bank regulatory constraints and public market volatility have expanded the addressable market for Apollo's origination platform, creating a structural capital markets shift that drives long-duration AUM growth.
Apollo's investment-grade private credit focus differentiates it from higher-risk direct lending peers. By targeting investment-grade or near-investment-grade credits, Apollo matches assets to Athene's insurance liabilities, which require investment-grade quality under regulatory frameworks. This drives Apollo toward larger, safer borrowers and distinguishes its risk profile from leveraged buyout-focused credit competitors.
Management provided constructive full-year guidance, with both fee-related and spread-related earnings projected to grow as AUM expands and Athene's portfolio scales. The AUM growth trajectory, from new fundraising and Athene capital inflows, is the primary driver of the multi-year earnings compounding story that distinguishes Apollo as a long-duration holding.
The analyst community's reaction to Apollo's Q1 result is constructive. A modest EPS beat with continued AUM growth reinforces the compounding earnings trajectory that the bull case depends on. Analysts who cover Apollo model on fee-related earnings and spread-related earnings growth, not GAAP earnings, and both metrics performing in line with or above guidance drives positive sentiment.
The private credit structural growth story is the dominant analyst bull thesis. Bank lending capacity has been constrained by regulatory capital requirements, particularly for non-investment grade corporate loans. This constraint has permanently expanded the addressable market for private credit, and Apollo, with the origination network, insurance capital base, and institutional relationships to scale, is positioned as the primary beneficiary of the structural capital market disintermediation.
AI infrastructure financing is an emerging growth vector that analysts are beginning to model for Apollo. Hyperscaler data center construction requires massive capital, financed through project finance loans, equipment leases, and corporate revolving credit. Apollo's origination platform is actively financing AI infrastructure through private credit instruments, creating exposure to the AI investment cycle without direct technology operating risk.
The skeptical analyst view focuses on credit cycle risk. Private credit portfolios are not marked to market on a daily basis, unlike public bond or equity markets, but credit losses from defaults or restructurings can eventually reduce spread-related earnings and impair the Athene balance sheet. Bears who model a credit cycle downturn, from recession, rate shocks, or overextension in leveraged borrower segments, see Apollo's spread earnings vulnerable in a stress scenario.
The perpetual capital advantage creates a structural valuation premium that analysts debate. Apollo's Athene platform provides AUM that doesn't redeem on a fund cycle, unlike traditional private equity funds with 7 to 10-year life cycles. The perpetual capital base supports fee stability and scale that pure asset managers with fund cycle AUM cannot replicate. Bulls argue this warrants a premium multiple over traditional asset managers.
The bull case for Apollo starts with private credit as a permanent capital market shift. As bank regulations constrain traditional lending, Apollo's origination scale becomes more valuable over time. The addressable market for investment-grade private credit is measured in the tens of trillions globally, and Apollo's market share remains small relative to the total opportunity.
Athene's perpetual capital engine is the compounding mechanism. Insurance liabilities grow as annuity sales compound, and Apollo invests those liabilities at spreads generating growing earnings independent of public market conditions. Bulls model Athene's asset base doubling over 5 years as retirement capital demands grow, creating a compounding spread earnings base with predictable growth.
The Rowan management premium amplifies the bull case. Rowan's vision for private credit as a systemic capital markets function, not just an alternative asset class, positions Apollo at a unique intersection of institutional asset management and insurance capital intermediation. Bulls see Apollo as the defining financial institution of the private credit era.
The bear case for Apollo leads with credit cycle sensitivity. Private credit portfolios accumulate during low default environments and face stress tests during recessions. If corporate default rates rise, investment-grade private credit assets could face spread widening and losses, reducing spread-related earnings and impairing Athene's balance sheet quality.
Regulatory risk is the second bear concern. If insurance regulators tighten capital requirements for alternative asset investments, reducing private credit that Athene can hold, Apollo's perpetual capital advantage would be structurally compressed. Global insurance regulators are actively reviewing alternative asset exposure within insurance company portfolios, making this a live and evolving risk.
Valuation complexity is the third bear concern. Apollo's dual reporting, fee-related earnings plus spread-related earnings, makes valuation more complex than traditional asset managers. If the market assigns a lower multiple to spread earnings as more credit cycle sensitive, the blended valuation could derate. Bears who see spread earnings as structurally riskier than management fees view Apollo as overvalued at current multiples.
Competition in private credit is intensifying. Blackstone, Ares, Blue Owl, and dozens of direct lenders compete for the same corporate and infrastructure lending opportunities. As capital enters private credit, spreads compress and deal quality deteriorates at the margin. Bears modeling private credit as a maturing market see Apollo's future credit returns declining from historical norms.
Blackstone is the largest alternative asset manager by AUM, with a more private equity-focused mix than Apollo. Blackstone competes in credit and real estate but commands a premium multiple, reflecting its flagship fund fee rates and brand positioning. Apollo's private credit and Athene Insurance overlay differentiate its earnings quality versus Blackstone's more private equity cyclical model.
Ares Management is Apollo's closest peer in private credit. Ares is the leading alternative credit manager with direct lending, real estate credit, and infrastructure credit platforms. Ares lacks an Athene-equivalent insurance platform, making Apollo's perpetual capital advantage the primary differentiation. Analysts who see insurance-backed private credit as structurally superior view Apollo warranting a valuation premium to Ares.
KKR competes across many of Apollo's segments in private equity, credit, and infrastructure. KKR has built its insurance platform through Global Atlantic, a direct analog to the Apollo-Athene relationship. The race between Apollo and KKR for leadership in insurance-backed alternative asset management is one of the defining competitive dynamics in financial services.
On valuation, Apollo trades at a premium to traditional asset managers with earnings quality and growth durability reflecting the private credit leadership and Athene integration. Bulls modeling AUM compounding toward $2 trillion and sustained spread earnings growth see the current multiple as conservative relative to the long-term earnings trajectory.
Apollo's options market activity heading into Q1 2026 earnings was moderate, consistent with a financial services company where the primary earnings drivers are AUM growth and spread earnings stability rather than product launch or event-driven catalysts. Pre-earnings implied volatility was below alternative asset manager sector averages. The modest EPS beat produced a constructive but measured stock reaction.
Post-earnings implied volatility compressed as the beat resolved near-term uncertainty. Apollo's beta of approximately 1.4 positions it as a meaningful market amplifier in financial services, sensitive to interest rate expectations, credit conditions, and risk appetite. Options market activity following earnings showed call buying on the private credit AUM growth theme, with positioning consistent with institutional confidence in the multi-year compounding trajectory.
Insider activity at Apollo reflects Mark Rowan's established CEO tenure. Rowan is a co-founder with significant personal equity holdings built over 3 decades. Scheduled plan transactions are the primary filing pattern. No notable open market purchases were reported in the most recent 90-day window, consistent with a founder-level executive managing diversification from a concentrated equity position.
The combined read from options and insider data is neutral to constructive. Moderate pre-earnings implied volatility reflected stable earnings expectations rather than binary event uncertainty. The EPS beat reinforced the AUM compounding story without creating headline surprise. For Apollo, the investment thesis turns on private credit origination scale and Athene spread earnings growth, both of which Q1 2026 continued to support.
Apollo beat Q1 2026 estimates with continued AUM growth and Athene spread earnings expansion. The private credit structural opportunity and perpetual capital base are compounding at scale.
Bottom line, Apollo is the private credit era's defining institution. The Athene insurance engine provides permanent capital that compounds the credit origination platform. The credit cycle is the risk, and the capital markets disintermediation is the secular tailwind.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.